Welcome everyone. In today's video, I wanted to talk about Vovo Finance. They are a brand new structured product protocol that recently went live on Arbitrum. And today I wanted to talk about them because they're offering something new and the first of its kind principal protected structured product. So let's get into it. But just first, I want to let you know that none of this video is financial advice and Vovo Finance is in its alpha. So obviously use this at your own risk and don't ape into any of the vaults here. So the basic premise behind Vovo Finance is that they take your USDC, put it into Curve, and then use the farming rewards from there to open up either leveraged longs or leveraged short trades on GMX, and then they will close those trades, and then whatever profit is made is then returned to the stakers. So for example, this is how the user flow is going to look like. A user will deposit funds into a Vovo vault. So they have the ETH up vault, ETH down vault, Bitcoin up vault, Bitcoin down vault. An ETH up vault, the funds will then go into Curve, and then those farm rewards will then be used to open up a leverage long on ETH USDC periodically. So this is what it will look like. So the user deposits funds, that goes into Curve Finance, then the farming rewards are then converted back into USDC, which then are taken over to GMX, perpetual swap, and then they'll open up a leverage long if you're in the ETH up vault, or a leverage short if you're on ETH down vault. And then after a while, they will close that trade, and then whatever profits that you receive are then given back to the user. So we see here that we also have the principal here. So if you want to pull out anytime, you can just get your principal back. And that's what's really cool about Vovo Finance, is that it is principal protected. And this is a brand new product to DeFi. I think it's the first of its kind. We do have similar structured products in the sense that, like, for example, you can go to Dopex and use this protocol to earn yield by selling covered calls or selling puts. But this particular structured product protocol is the first of its kind in DeFi. So in traditional finance, a principal protected note is a structured finance product that guarantees a rate of return at least the principal amount invested, as long as the note is held to maturity. So a PPN is a structured zero coupon bond. So it's a bond that makes no interest payment until it matures, and an option with a payoff that is linked to an underlying asset, index, or benchmark. So what they're trying to do here with Vovo Finance is replicate this, but in a decentralized finance sort of way. So instead of using options and instead of using bonds, they're using Curve Finance and GMX, using the flow that we saw here. So instead of using bonds, they're using Curve Finance because you can get a return. So that's the farming rewards. And then instead of using options, you're using perpetual swaps instead. And they outline some reasons for this here as well. Basically, it's just easier. They're more liquid, while perpetual swaps are more liquid than options in DeFi anyway. So it just makes more sense in order to do that. So here we go. Here's the user flow again. And we can get more into exactly how it works. So let's take a look at how the APY of each Vovo vault is actually calculated. So we have to take two things into account: the base APY from the curve pool, and whether or not the vault bets on the right market direction, because you're either entering an up or a down vault. Now, if market conditions are favorable, then the up vault's going to be more profitable, but if market conditions are not great and we're in a bear market, then the down vault is obviously going to be more profitable. So using the Curve 2 pool, USDC, USDT, current APY is at 7%. So they did some tests to see what the APY would be like for the ETH up vault and the ETH down vault. So the vaults collected Curve rewards from the Curve pool each week and then swaps the yields to USDC, and then uses that USDC to open up 20x leverage long or short positions on GMX, and then that position was closed after a week. And so these were the results. They did comparisons with different leverage levels, so from 5x to 30x, and that they found that 20x leverage was the best average performing APY for the long period. And then the backtest, after deducting fees and slippage costs, showed that the APY is 1.5x to 3x of the base APY if users bet on the right market direction. So that's it, 1.5x to 3x the 7% APY. So you could get up to 21% APY if you are betting correctly that the market is going in a certain direction. So as you can see here, and above half of the base APY if betting on the wrong direction. So if you don't get this right and you're in the wrong vault at the wrong time, then it's probably not actually going to be worth your time, and you will probably be better off just stablecoin yield farming in Curve anyway. However, these are the average APY for a long period of time. The actual weekly APY ranges from 0% to 156% for the past 4 years, and around 60% of weeks having 0% APY when the positions are liquidated. But for the other 40% of weeks, the APYs are normally above 30%. So that's something you're going to have to take into account as well, is that it's not going to be profitable every week, and you're going to have to pick and choose when you actually want to enter these Vovo vaults to get the most out of them. So if we just take a look at the page itself, we can see here that the last week APY hasn't actually showed up, so we can't see its previous performance because this is a new protocol. It recently just went live on the 14th. As I'm recording this video, it's the 16th, so it hasn't ran long enough so that we could actually see the APY figures. So right now we only have Ethereum and Bitcoin vaults, and obviously that's because the protocol has just started. If we go into GMX, I'm assuming whatever GMX has listed is whatever is going to come in the future. So that's ETH, Bitcoin, Chainlink, and Uniswap as well. The rest of these are all stable coins. So this isn't something you have to pay attention to, but Chainlink and Uniswap are potential next listings for Vovo Finance. And so to actually go ahead and use Vovo Finance is actually quite simple. If you look at the user guide, it will just walk you through it. All you need to do is connect your wallet, go to this vault, and then deposit your USDC in here, and you'll have to pay obviously transaction fees, but it's on Arbitrum, so it's really not going to be that much. But if you're only depositing like small amounts, then obviously it's going to cut into your funds, but Vovo Finance is still in alpha, so it doesn't really make sense to put in a lot of money here. So that's definitely just something to consider. Now, just quickly comparing Vovo Finance to structured products that we already have on Arbitrum. So if you're familiar with Dopex, you can deposit assets into the single staking option vaults, and then they might sell a covered call or a put against the asset, and then you can receive yield against it. So basically what happens, you deposit ETH into the ETH vault, they take that ETH and then sell a covered call against it, and then whatever options premiums are generated from selling that covered call, they are then returned to the vault stakers, and then at the end of the week you can withdraw your money. And so let's just take a look comparing the option structured products compared to principal protected products that Vovo Finance offers. So whilst most option vaults advertise 30% annual yield, this is based on the assumption that the options always expire out of the money. If the options expire largely in the money a few times a year, the yield won't be that good. In fact, the historic performance of many of the existing options vaults are negative because of the recent high volatile market conditions. Nevertheless, while you may not find it profitable if your fund stays in the same decentralized option vault for a year, it is still a very profitable strategy for a certain period if you think the market won't move against the direction you believe in. And so this is just what it's going to look like in terms of your comparison. So this is the decentralized option vaults, so what you have with Dopex. And then we have the Vovo vaults, so comparing them on APY, the decentralized option vaults have a good return most weeks, and negative return minority of weeks, and the Vovo ones, the APY is medium or good half of the weeks, and then 0% return for the other half of the weeks. And then we also go to risks here. So the decentralized option vaults, they might suffer a big loss for certain weeks and then have a risk of losing the principal in the long term, whereas the Vovo vaults, they can obviously have the risk of earning 0% return for certain weeks because the position gets liquidated, but the principal is protected for the long term. So that is definitely something to consider, is that half the time you're going to make money, half the time you're not going to make money, but you're not actually going to lose money, which is cool. In fact, you can actually just replicate this yourself if you think about it. Whatever yields that you're getting from your yield farming, you can just convert that into USDC and then just do some leverage longs or leverage shorts and then you won't actually have to use Vovo Finance. But for convenience sake, it can make sense for you to do this. So staying in these vaults long term doesn't really make much sense to me. I think, you could use something like a basic moving average to help you actually time when you're getting in and out of these vaults, or like a basic moving over crossover strategy. So like, say the 5-day moving average and the 20-day moving average. If the 5-day moving average crosses above the 20-day moving average, and then typically that's a bullish sign, so you might then want to enter one of the Vovo Finance vaults. And then if it crosses down, then that's typically a bearish sign, and that's when you might want to enter one of the ETH down vaults or one of the Bitcoin down vaults. But of course, this isn't financial advice, and it's just up to you. So in regards to whether or not Vovo Finance is actually safe, well, they say here on their own page that it's still in alpha mode. So definitely don't go in and ape in a ton of money. You still obviously have the risk of GMX failing. You have the risk of Vovo Finance failing, or either one of those protocols getting exploited. You also have the risk that Arbitrum goes down again, because Arbitrum has gone down several times where it's just not actually been accessible. But I'm sure there's ways to still get out of the smart contracts and make sure that you don't actually lose money. From my understanding, the team is also not doxed, and so that's obviously something you're going to have to keep into account. However, I highly doubt someone would bother making something like Vovo Finance in order to rug people, because it's, like I said, the first of its kind, and it requires like lots of thought to go into it. Usually when we have rugs, it's a copy paste of like another protocol, and so they've made something new, and I think it's unlikely that you're going to get rugged. But of course, there's obviously always smart contract risk, so be careful with Vovo Finance. If it's not something you want to touch for now and you want to wait a couple of months to see if it's really battle tested, then I really wouldn't blame you. So thank you for watching. I hope you enjoyed this video, and make sure to subscribe for more videos like this one.